In today's episode on Options 101, what we're going to do is we're going to go ahead and take a look at options calls versus puts and how do they work. And we're going to take it at a basic or a beginner level. We're not going to go into crazy depths of them because you could obviously take these to in a higher extreme level. But if you're brand new, you're just getting started, you probably just want to understand, hey, what the hell is this stuff going on? And in that case, maybe that's all you really want. Now, if you're brand new, definitely check out our website. There's a lot more training and material there. There's also some getting started courses, books, and other good stuff. So you could also go to tradersfly.com and learn a lot more in that area. Let's get started. We're going to go ahead and check things out. We're going to go to a thinkorswim platform here. This is where we have two distinct areas where we have the calls on the left, puts on the right. And this is how most brokers do it. They have calls here and puts over there. Some brokers may do it a little bit different, but in general, we have calls and puts. And if we go in and zoom into this section, you can see here is our days to expiration, okay? And that is the date they expire. So if we open this up, we've got the expiration date and days to go. And then in the middle here, we've got strikes. So this is the strikes where, hey, if the stock hits it, you're either going to be either in trouble or a happy camper. This is where you might want the stock to go. So here we have the call side and here we have the put side. So let's go back a little bit and take a look at how this works and operates. So we're going to go on paper actually, and we'll take a look at what is a risk profile picture when it comes to buying a stock. So how does it work? The way this works is I've got the price of the stock right here. So if the stock price is 180 and that's the price I buy it, I'm going to put a dot right here. Okay. Now, if I buy 100 shares, what's going to happen is my risk profile picture might look something like this. So if the stock goes to, let's say 220, what I do is go to 220, that is my picture, and now I go over here and say, oh, okay, well, I'll make about $1,200, okay? So what you're doing is matching up the price of the stock to the profit or loss on the left side. So this is what a stock risk profile picture looks like. Now, what does a call risk profile picture look like? So it's going to look a little different. It's actually going to look something more like this, okay? So you're paying a certain amount. This is what you pay. Now in a stock, you pay a certain amount too, and that stock can go to zero. But with an option, the good news is that you actually pay a certain amount, and that is the most you risk. So if you pay $1,200, that's the most you can lose. And then if the stock price heads higher, well, let's say it gets to 200, well, you're up $800 or so. So this is the way that it works and operates. Now, the thing with options though, is it's a little tricky in that you have two lines. This line that I just showed you, this is the expiration line, but there is another line that is known as the T+0 line or the two-day line. And what happens is that this line gets closer to the expiration line and you lose money every day from time decay, okay, or theta value. Now we can look at this on our panel and platform here. And the way that we can do that is if we go to, let's pull up a stock like Spotify. What I can do is buy a single 100 shares of stock here just to show you what this looks like. So I've got 100 shares of stock. I'll analyze this and I'll get rid of some of these price slices so it's not confusing. So here it is. This is what we saw earlier where if the price of the stock heads higher, I make more money, okay? If the price of the stock heads lower, I lose money, okay? Because I've got 100 shares of Spotify, okay? Now this is a simulated position, right? It's not executed. We didn't buy anything. It's just, hey, let's look at this, a risk analysis and see what the risk would be. If I go ahead and start increasing these number of shares, that picture starts to turn and you basically get more angle to it, okay? So let's go back to 100 shares. Now, looking at the option side, buying a single option, let's buy the 175 and we'll buy a single. We will right click, analyze that trade. And now here is our risk profile picture. Now I will switch this to, well, let's leave it as is. Okay, we'll look at it like this, but you have two lines here. The line that is, the white line, that is today. The green line is at expiration. Okay, so when we look at expiration, this is normally what we're looking at. That's the most we can lose. But the line that really matters is the today line. And that is this white line. So right now I've got like 38 delta, which is like 38 shares in this concept. And if it goes up, you make money, and you make about $38 for every dollar move higher. So if I go right here, I'm down 15 bucks. If I go up, let's say $1, just add about 38 to that. Okay. And now you're up 23 bucks, right? Because we started with 15 lower. Okay. If I did this with a stock, and we go and check mark this, I've got 100 delta. So what do you think happens? We're down 40 bucks to start. So if I add 100 or add $1, we go up $1 and I add 100 to that, should be up about 60 bucks, right? So there it is. I'm up about $60 in that case. So the point being is that the amount of delta that you have is how fast you'll make money or also lose money in that position. So if we go with an option and we buy a single call, we want that to continue to appreciate and we want the stock price to go up. What I'm doing here is when I buy a single call, I'm saying, hey, I will take that stock if it gets to 175. I will buy it if it gets there. And what I will do is I will pay $600, because that's the most I can lose right here, $600 to have that ability, to have that contract at hand. Because if that stock actually gets to $200, I can still buy the stock at 175. If it gets to 220, I can buy it at 175. If it gets to 230, I can buy it at 175. That's the way the call option works. But normally you don't go in and let's say the stock gets to 200, you don't buy the stock at 175 and then sell the shares back at 200. Instead, just the value of that option increases and you can just sell that option for more money because it's tied together. So you can just say, hey, you know, the stock got to 200, the option value just increased to about 2,000 bucks. And then if you actually did buy the stock then at 175 and then sold it at 200, you'd be in the same spot anyway. So the value of the option, they're all tied together. So understand that concept that you don't have to, go in, buy the stock, and then sell it again later. And you could get out of this anytime earlier even. You could say, hey, you know what? Even though my option expires on August 11th here, which is about 30 days from now, I could actually get out at 183. Or even if it goes up very quickly and it doesn't even reach 175, it could go to 170. If the value of it increased a little bit and I didn't lose a lot of time value, I could actually sell this position and just make 170 bucks as well. But the point is I'm only risking 600 bucks compared to doing a stock here. You know, I'd risk a lot more. I'd risk about $16,000 because the stock is $165. So that's the thing with a call is that you're saying, hey, I'm willing to take that stock at this price point, that strike that you have, if it gets there or higher, and you're paying some money to be able to do that. Now that can get expensive with time and not always cost effective to do it time and time again. There's other strategies out there that mitigate some of the other risk. But if the stock does explode, you could pick it up at a lower value. Or in other words, the option contract itself increases quite a bit. So that's the power behind kind of these call options. How do we do this on the put side? So if we go in and look at this on the put side, let's buy a put. The put actually works a little bit opposite or in reverse. So the way it looks from a risk profile picture is something like this. So you're paying a premium to actually be able to put that stock to somebody. So why would you buy a put? Let's say you owned 100 shares of stock, and then you go in and say, I want to insure my position. So then you want to put that stock to somebody else. So you ultimately have 100 shares, and then you buy one put because you say, I want to put it to somebody. But the put itself actually is a downward position. So if you just buy the put on its own, it's going to look like this. But if you buy a stock and buy the put, it's going to look like this. So watch, I'm going to show you. It's going to be kind of interesting. So let's go in right here, and we've got 100 shares of stock. And let's say you've bought this stock at, in this case, we've got it at 165 or so. Okay, so it's kind of moving around or wiggling around here. So this stock's at 165 right now. And let's say you want to be able to put that stock to somebody at 150. So if it goes to like 110 or 100 or $0, you want to put it at 150. So I can go to the put side and then buy a single put for $340. And that will protect my 100 shares of stock. And I will analyze this and take a look at what it looks like. It looks exactly like a call. Why? Because I'm capping my max loss. So buying 100 shares of stock plus buying a put reduces my downside. So this is the way most people would use it: is I've got 100 shares of stock, and if it keeps going, I don't lose more than $2,235. Whereas if you just had the stock, this stock could actually go to 120 and you could lose, let's say, $5,000, $6,000. So you could lose a lot more. But once you add the put in there, you can lose a lot less. You can lose just $2,235 and you paid a bit of money to have that. But take a look at what it actually looks like. It actually looks like a call, doesn't it? But the put on its own, if you buy the put on its own, it's a negative kind of basis. So it actually looks more on the downside. You have a negative delta here. So as the stock heads higher, the put value increases. So it continues to increase, and then it behaves like a stock ultimately, because you're converting the delta into a stronger and more powerful position. So this is the way the put operates. So if you're buying a call, you want prices to usually go to the upside. So let's look at a call. Prices, I want them, and let's put it at 165. If I buy a call, I want the stock price usually to head higher. I'm buying a single call. I want that stock price to head higher. If I'm buying a put, I want prices to head lower, okay? But if you buy a put with the stock, you still want prices to head higher. It's just that you're capping your max loss here because you're able to put that stock to somebody else. So what you've got is a bullish or positive or bullish position on the stock. And then what you also have is a negative position on the option with the put. And that way it flatlines that point at a certain level. It flatlines your losses at a certain level. And that's the way calls versus puts kind of work, in terms of, hey, for a put, you want prices to go down. For a call, you want prices to head higher. And at a basic level, that's the way it works. It's just, hey, if you want the stock price to head higher, buy a call. If you think prices are going to head lower, buy a put. But in most cases, what people do is when they buy the put, it's usually when they have 100 shares of stock, and then they buy the put to protect that position. So I hope that makes a little bit of sense and opens you up. I would highly encourage you to check out kind of our mini course and check out the options jumpstart course at tradingwebinars.co. And when you go in and search for this, tradingwebinars.co, there's a lot of different mini courses and series on there, and a lot of things you could watch to get yourself started. It's absolutely free, so I highly encourage you to check that out and go ahead and just grab yourself a mini free course to learn more about options trading, especially if you're brand new. Anyways, thank you so much for joining me. Hope this helped, and continue to watch some other great videos on the channel if you like this information and content. And I will see you in the next episode. Thanks, and take care.